This presentation will provide an introduction to accounting. It will be of benefit to those managers and individuals who have no formal financial accounting qualifications. In this presentation, we are going to explain the nature and purpose of accounting. We will discuss the nature and purpose of the balance sheet, and we are going to prepare a basic balance sheet. Moreover, we will explain the nature and purpose of the profit and loss account, and we are going to prepare a basic profit and loss account. Now, what is accounting? Accounting is a process which involves the identification, measurement, and communication of financial information about a business in order to permit informed judgments and decisions by the users of that information. Now, the purpose of accounting. What is the purpose of accounting? A business owner normally runs a business to make money. The following questions might be asked by the owner of a business. How much profit or loss the business has made? How much money do I owe? Will I have sufficient money to meet my commitments? The purpose of business accounting is to provide answers to such questions. Users of accounting information can learn a lot about the running of a company from the examination of the financial statements of that company. But who are the users of accounting information? Users of accounting information include the management and the owners of a business. As you understand, these people, for obvious reasons, they want to know whether a business has made a profit or a loss. The employees of a business will look for, among other things, security of employment. Employees will most likely ask for a pay rise if the business is doing well, or they will look for employment elsewhere if the business is not profitable. The tax authorities come next. We know that two certain things in life are tax and death. So, tax authorities will use the account to determine the liability of the business for taxation. Competitors will want to compare the results of their company with the results of other companies. Banks and other lenders will want to know if the business will be able to repay bank loans and interest charges. Finally, a prospective buyer will want to see the financial statements of a business, because financial statements will help a prospective buyer to decide whether the business is a good investment opportunity or not. So, financial statements aim to meet the needs of a wide range of users, such as those we just mentioned. These statements, as we will see, are presented in a standard form. So, the major financial statements include the profit and loss account, which shows the sales, expenses, and the profit of a company over a period of time. Also include the balance sheet, which shows the value of a company's assets and liabilities at a particular point in time. Now, the balance sheet reflects the accounting equation, which is assets minus liabilities equals ownership interest. So we saw that assets appear at the top of the accounting equation. Let us then start with assets. What are assets? Assets are things that are owned by the company and are normally categorized as being non-current or current. Non-current assets, also known as fixed assets, are held for use within the business for long-term operations. So, non-current assets or fixed assets are used as part of the productive capacity of the organization. They are not for sale in the ordinary course of business. So these include premises, motor vehicles, and equipment. Now, the next category is the category which includes the current assets. Current assets are assets which are held for sale or consumption in the normal course of business, or are held for the short term. These consist of stock, debtors. So, who is a debtor? A debtor is a person who owes money to a business for goods and services supplied to him or her on credit. So, current assets include also cash at bank and cash in hand. Having discussed what assets are, let us move on to discuss the liabilities of a business. Liabilities may be seen as the opposite of assets. They reflect financial obligations of the organization. They are split into current liabilities, which are liabilities that have to be paid within the next 12 months, and these typically include creditors and taxation. Creditors are people to whom money is owed for goods or services. So the next type of liabilities is the current liabilities. These are liabilities that do not have to be paid within the next 12 months. They have to be paid after more than 12 months. These typically include bank loans. We have said that assets minus liabilities equals capital. But what is capital? Capital is the total resources invested and left in a business by its owner. So the owner's equity or capital reflects the financial interest of the owners in the organization. But how can this be found? It can be found by deducting all of the company's liabilities from all of the company's assets. As we have said, assets minus liabilities equals capital. Right, let's look at an example. So let's say you want to start a new business. You have 70,000 euros. With this amount of money, you can buy a small office, you can buy some equipment, and you will have some cash in hand left. However, the business needs stock. It also needs a motorbike. So what does that do? You go to the bank and you borrow 30,000 euros. With this amount of money, you can buy your stock and you can buy the motor van that you want to buy. Now, the value of the assets that you as the owner of the business control is 100,000, and it includes buildings, equipment, cash in hand, the motor vehicles, and stock. Now, we mentioned earlier that fixed assets are permanent assets used as part of the productive capacity of the business. But nothing is permanent. Fixed assets may become damaged or useless and sometimes need replacement, which brings us to the concept of depreciation. So, non-current assets are gradually used up in providing goods and services over time. So non-current assets lose value because of the passage of time, because of the level of usage, or because they become technologically obsolete. So the purpose of the depreciation calculation is to spread the total cost of an asset over its expected useful life. Let us now look at an example. So Mark has purchased a new piece of equipment to help speed up his production line. The equipment cost £25,000 and is expected to last for 3 years. At the end of this period, the equipment is expected again to be sold for £4,000. Now, depreciation is a method of allocating cost. A common method of calculating depreciation is the straight line method. The formula is what you see here. So you can see that in order to calculate the annual depreciation charge, it is necessary to work out how long the asset is likely to last and what can be sold for when its expected life is ended. So you can see that if we buy the asset for £25,000 and we sell it at £4,000, the asset within the next 3 years will have lost £21,000, which is equal to £7,000 per year. So when it comes to recording depreciation, we always start by recording the asset at cost, and then we deduct the depreciation charge for the year. You can see that the depreciation charge for the year is 7,000. The net book value of the asset is assumed to be 18,000. By net book value, we mean the value of the asset on the books. So year 2, we see that as the asset becomes older, the depreciation of 1 year is added to the depreciation of previous years. So year 2, the total depreciation is 7 plus 7. Year 3 is 7 plus 7 plus 7. You can see that at the end of year 3, the value of the asset is 4,000. However, this is not what the actual value of the asset will be. You may attempt to sell the asset, and the asset may fetch either a higher amount of money or a lower amount of money. So now, having explained the nature of assets, liabilities, and capital, which are the main parts of the balance sheet, we are now going to talk about the other major statement, which is the income statement. So this is a statement that shows the deduction of expenses for the year from revenues during the year to give a profit or loss for the year. As we will see later, the income statement reflects the part of the accounting equation which defines profit. Now, to summarize, profit equals revenue minus expenses. So, let's say that you operate a small business. You buy and sell oranges. At the end of the year, you have gathered the data that appears at the right-hand side of the screen. You want now to calculate the profit you made this year. So you want to prepare the income statement. You start with revenue, which is the financial value of goods and services sold to customers. Now you have to calculate the cost of sales. You spend, let's say, this amount of money for purchases. By purchases, we mean goods bought by the business for the prime purpose of selling them again. Now, at the end of the year, there was some unsold stock. This is called closing stock. The value of what you sold is purchases minus closing stock. The next step now is to calculate the gross profit, which represents the profit from simply buying and selling oranges. To find your net profit or net loss for the year, you deduct the other expenses from the gross profit. So the net profit for this year is 8,791 euros. This figure represents the wealth generated during the period. It belongs to you, the owner of the business, and will be added to your capital in the balance sheet. So the preparation of the balance sheet comes next. We begin with the fixed assets. These are permanent assets of the business which have not been purchased with the intention to simply resell them. These assets include premises, motor vehicles, and equipment. The other now category of assets includes the current assets. These are assets which consist of stock, debtors, cash at bank, and cash in hand. If you remember, we mentioned that debtors are people who owe money to your business for goods and services supplied to them on credit. The next now section is the section where the current liabilities are recorded. These current liabilities have to be paid within a year of the balance sheet date. They include creditors, who are people to whom you owe money for goods and services you purchased and have not yet paid, but you have, as we said, to pay within the next 12 months. The final part of this balance sheet is the capital account. You begin with the value of resources you originally, that is 1 year ago, invested in the business, which in this case was 40,000. Then you add the profit or wealth that your business generated during the year. From that total, you deduct the drawings, which represent money or goods taken out of your business by you for your private use. So you can see that assets minus liabilities equals capital, and revenue minus expenses equals profit.